How's it going, everyone? My name is Amos, and I'm going to be honest with you, I'm still feeling it. I'm sick. So I took some Dayquil prior to filming this video. Hopefully I have the energy to make it through. Shout out to Dayquil. Dude, that stuff is a lifesaver. Now here's my little disclaimer up front. What you're about to watch right now, this could basically be if I was new to the stock market, what would I do as a beginner video. So with that said, today we're going to be taking a look at Jimmy's portfolio as if it's an MBA case study assignment. And mind you, this is part 4 in the Roast My Portfolio series, where you guys, the viewers, have been submitting your portfolios to the channel, and I analyze and break it down for everyone to learn from. So Jimmy, what you see on your screen right now, he's 24 years old, and he just started investing into the stock market 5 months ago. And he works as an HVAC technician. He just passed every single one of his trade school classes and is now working in the field making pretty good money. And instead of buying a new Tesla or getting a tattoo on his left butt cheek, he's choosing to put a part of his paycheck into the stock market, which I would argue pretty wise for a 24-year-old. And can we just take a moment to pause and look at how handsome Jimmy is? He really reminds me of a young Will Smith when he used to be relevant. And one of my most favorite shows growing up was The Fresh Prince of Bel-Air. Dude, when I used to come home from school, that's the show I used to watch. But speaking of the trades, I tuned in to my alma mater's board of directors meeting, and they were talking about how the young male demographic is shifting away from going the traditional path that we prescribe to the kids in high school of like, hey, you gotta go to college. Instead, more and more of them are choosing to go into the trades or enlist into the military straight after high school. And that effect is causing an imbalance in the enrollment numbers for matriculating freshmen, where it skews heavy towards female students. It's kind of an interesting dynamic to experience and see, because I know there's a crap ton of people out here who say that college is a scam in itself. And even though I don't see eye to eye with that argument, it's going to be interesting to see how I went to a military academy for my undergrad. My master's degree was a little different, but if you know anything about the military academies like the Air Force Academy, West Point, Citadel, and everything, it's predominantly male. But to see the demographics shift to being more female cadets and midshipmen being represented, it's going to be an interesting result and trickle effect in the next 5 to 10 years, where more and more commissioned officers are going to be women. It's going to be cool. So what you see on your screen right now, I have Jimmy's portfolio pulled up, and Jimmy's current portfolio strategy is safe and steady growth. He's not trying to 10x his money overnight with YOLO options or day trading. And his goal is pretty simple. It's to learn and to make as little mistakes as possible, because as I just alluded to, he's only been investing into the stock market for less than half a year. And a mistake would be an investment going belly up or going deep into the red. He wants to reduce that as much as possible. And I do want to call out, what you see on your screen right now are 14 individual stocks that are present in his portfolio, but he does have a few index mutual funds as well. However, we're just going to go ahead and focus on the individual stocks. And at the time of making this video, if I zoom in right here, take a look at where my purple mouse is, the current portfolio valuation is $4,762, which means just from his individual stocks, the annual dividend payout is $55.19. The overall dividend yield is 1.1%. Dividends paid out, dividend yield. And what's interesting is his total profit is 7.8% into the green. Pretty good. And after looking at and thinking about and analyzing his portfolio for the past 2 days, these are my high-level thoughts and opinions. Number one, I think it's important to keep in mind that Jimmy is new to the stock market. So if you're looking at his holdings and going, what the heck? And he's also 24 years old, try to think about this from his point of view and in his shoes, which is probably a pair of Jordans. He's got some class. He's a man of style. When you're new to the stock market, if I'm going to be honest with you, it's going to feel exciting, but at the same time, it's going to be scary and a little overwhelming. because there's so many different attributes, variables, factors, fundamentals, metrics, and financials that you got to be cognizant of in order to be successful, or as they say, right? Or you could just jump right into it and buy VTI or whatever. And my second observation is this. He jumped into the stock market when they're currently at an all-time high. He bought into them like a month, 2, or even 3 months ago, and they're at about their 1-year high. And I would argue in the span of 3 to 4 months or so, not bad. I'm looking at the percentage. Is this too small? Let me make it a little bigger for you guys. So if we look at the percentage change, after buying into Apple, his cost basis, he has 1 share, $200. It's up by 27.7%. Pretty good stuff. And what's another one that's a pretty big winner? We got Palantir, 21.8%. He bought into it at the dip when it was $145. Anything else that kind of stands out? I would say TKO, the parent company of the UFC and WWF, 20% gain, and then Tempest AI, 14.7%. So even though he bought into these stocks while the stock market was roaring to all-time highs, it is worth noting that time in the market beats timing the market. In the grand scheme of things, in 20 to 40 years, is it really going to matter? Because once Jimmy is 55 or even 69 years old and he looks back, this is going to be the most perfect time to jump in. And that's why if you're sitting on the sidelines with cash, I know there's people out here, they've been holding on to cash since the end of 2019, early 2020, and they just have not jumped back in. Dude, you're missing out on so much. And I'm not trying to invoke emotions of FOMO. It's just there's people out here that try to time the market itself, and I feel like that's a losing game. Now, I don't want to come off as a hypocrite because I do time when to buy into individual stocks, but I try not to time the broader market. Case in point, I'm always investing. Every single week, I'm dollar cost averaging or buying into a stock. If I see that it's at a low valuation, I'll just add a little bit more. And my third observation is this. If I click on the diversification, biggest holding is Microsoft, 21.4% of the portfolio. He has 1 share, and that's because Microsoft is like $500+ right now. Second biggest is Nvidia, and then Northrop Grumman. And then we have O'Reilly Automotive, which is kind of like AutoZone or Advanced Auto Parts, TKO. The point is, it's all over the place. I don't really see a coherent strategy. However, given the context that Jimmy is 24 and Jimmy is new to the stock market, it makes sense. Now, if Jimmy was 60 years old and he's been investing for 30 or 40 years, dude, I would call it out accordingly and be like, dude, what are you doing? Like, what is the strategy here? But going off of some assumptions, I'm gonna go ahead and say he's investing into the very shiny and popular stocks that's trending, and then the stocks that are also relevant to Jimmy's occupation. And I say that because he has Vertiv Holdings, which is in the HVAC space, but he also has O'Reilly Automotive, which I'm going to go out on a limb to say that's probably where his company gets all of their auto parts to fix up their vans. And then some of these stocks Jimmy probably bought into because it's relevant for him. Like, he's probably a huge fan of the UFC, he probably has an iPhone, and his trash collector every Tuesday and Friday is probably Waste Connections. Making assumptions here, but that's probably what I'm seeing of how he decided to buy into some of them. And to be honest with you, I'm not going to judge or criticize Jimmy for having such a random array of stocks in his portfolio, because when I was new to the stock market in 2018, 2019, I did the exact same thing. I bought stocks of companies and brands that I used every single day, or the stuff that I enjoyed, like Nike, Texas Roadhouse, Nvidia, McDonald's, and funny enough, it's how I actually made my way into dividend investing by buying into Dominion Energy, which is a utility company that's based in the East Coast, but predominantly in the state of Virginia. And at the time, I was getting my MBA in the state of Virginia, so I was paying my electric bill to Dominion Energy, and then I found out, wait, hold on, there's such a thing as dividends, where a company gives back an allocation of their profits towards its shareholders for believing in them and investing in them. So I was like, hey, if I'm gonna pay my electric bill to Dominion, I want them to pay me back. So it was almost like a break-even kind of a deal. And funny enough, after all these years, I still haven't sold out of Dominion. And I say it's funny because I don't really believe in them, because I think in the utility space, I can list like 5 or 10 other utilities that are way better than them, but it's just, I guess it's sentimental. I've been holding on to them for so long. It's at that point where it's like, why should I sell them? I'm in the green. They pay a reliable dividend, and at this point, it's basically a proxy for a bond. They pay a pretty good dividend yield, and the share price goes up a little bit every year. Now, in the next segment of the Roast My Portfolio, we're going to go through the 4 metrics for his portfolio scorecard. The first one is going to be the asset and strategy fit. Basically, do the positions and the holdings make sense for their goal? Safe and steady, and to learn and to make as little mistakes as possible. For that, overall, I would give it a C+. I think it's about in line with what a beginner is doing, and it's not full of crazy speculative bets. So I would say it's slightly above average, which means it's neither good or bad, just about average. And the good news is almost every single one of his holdings are profitable, except Tempest AI, which is a medical AI analytics company that was made famous because of Nancy Pelosi. She bought into it before everyone else knew about it, and then it blew up. And then also another one that's kind of not profitable, one could argue, is Alti. He is invested into the Yield Max ETF, and the opportunity for improvement here is instead of a spray and pray, because Jimmy is invested into the most random array of stocks, with a portfolio valuation less than $10,000, I would argue go bigger into the ones that you deem as safe and juicy. Because think about it like this. If you make a 15% gain on one stock, and let's say that stock is like $100, then you made $15 in unrealized gains, correct? However, if you were to go bigger into your one real true conviction, the stock that you really believe in to your core, to your left nipple, and you make a 15% gain on that one stock that you have $1,000 into, then your unrealized gain is $150. So instead of like having one share here, one share there, one share here, like I get it, right? When you're new, I think people diversify because that's what Warren Buffett advocated, right? When you're new and you're ignorant or you don't know all the ins and outs, you have to diversify away your risk. That way your winners can outweigh your losers. But as you get more and more experienced in the stock market, you want to concentrate your holdings. That way your winners really win. But then again, I don't want to get ahead of myself because that takes time and experience and learning about your risk tolerance. Because the last thing that I want to see is Jimmy going 100% into one stock and then that stock getting delisted because of a scandal. He loses everything, right? So you got to learn first before you make those kind of decisions. And then when we think about the level of risk, 0 to 10, 10 being absolutely risky. As it stands right now, Jimmy's portfolio, I would give it a 4 out of 10. I would say it's moderately safe, or I guess half glass full, half glass empty, moderately risky. And I say that because I love that there is a trash management company, WCN, for protection on the downturn. But when you think about it in a market correction or recession, dude, Jimmy's portfolio is easily going to go 20, 30, 40% into the red because it's overwhelmingly represented with growth stocks and Alti itself. When you think about the holdings within Alti, who they're doing their option strategy for, it's all hyper growth companies. But then again, friends and family, Jimmy, he's 24. We're not talking about someone who's 60 or even 65. At 24 years old, I think that's going to be okay. Going through a recession is not the end of the world because as a 24-year-old, you've got time on your side to weather it out. And on average, historically, recessions last for about 10 to 11 months. So you'll see your portfolio be shattered and absolutely crushed for about a year. But then after that, it'll slowly trickle back up and then you'll break even and then you'll go back to being in the green. Time is your best asset in the stock market. Now, if you don't have time, that's where you really got to be strategic with what you pick and choose to invest into. But that's for a different conversation of its own. And in terms of the quality of holdings, going from A all the way to an F is like outrageously bad, whereas an A is superior. Excellence, front to back, everywhere, start to finish. For Jimmy's portfolio, I would give it a B-. It's slightly above being an average because he has the Mag 7 represented. He has all of the heavy hitters, but he also has some of the weird ones, right? So 8 out of the 14 are super high quality, and the other ones are just okay or average. Now, out of the entire portfolio, the only one that I do not like at all is Paramount. Right now, they're currently $18.92. The reason being that I do not like them is if we jump on over to their financials, when we look at their revenue, 2017, friends and family, take a close look at this. 26.5 billion. And since then, it goes up, it goes down, it goes up, it goes down, and it's currently 28.7 billion. So their financials and the growth story for this company objectively shaky. And when we take a look at their profitability, which is represented by the earnings per share, they're currently posting -2 cents per share outstanding. Right here, they have 671 shares outstanding. And it seems like instead of buying back the shares, they're issuing more shares year over year. Now, before I go any further, in case you don't know, Paramount is a production media company. They release movies, TV shows, and various streaming platforms. And if we jump on over to their cash flow statement, I would argue their competitor and peers would be Warner Brothers, it would be Netflix, it would be Amazon Prime, Disney Plus. I think you get the jazz. When we think about their free cash flow, that's actually surprising. I think since 2022, that was pretty rough. It was negative 139 million. It's been improving year over year. So it looks like the cash from their operations are looking a little better. What about the dividend situation? They pay a dividend, a 1% dividend yield. I mean, they just got listed on the stock market because of their merger with Skydance back in August. And as you can see, since that merger, they're ripping to the sky. 62% in a matter of like 5, 6, 7 weeks. It's pretty darn impressive. But if we think about Paramount as a fundamentally sound investment, the financials are not there. However, it seems not to matter because they're ripping to the moon. And I think that's because I saw an article in the Wall Street Journal talking about how Paramount's trying to buy out and acquire Warner Bros. Or something like that. So they're about to become a bigger streaming giant. I think that's what the market is betting on. But we don't know if that's going to go through or not. And then for the last metric, number 4, dividend sustainability. Jimmy, he does not really care about dividends. And to be honest, I can't argue with that. At 24, some people say that you shouldn't even be interested in dividends at all. I disagree with that. But if you're not interested in dividends at 24 or even 29, I think that's completely okay. I think it takes time. I always say this. Everyone that's a growth investor eventually becomes a dividend investor once you get burned enough times, or once you pivot and transition your portfolio from high growth to becoming a sustainable passive income machine. Everyone eventually does go on team dividends. It just takes time, whether it's going to be at age 18 or at age 72. Team dividends is welcoming everyone. But at 24, dividends or no dividends, I really don't think it should matter that much. I think you should be prioritizing preserving your capital, but also growing that capital as much as possible. So in terms of what adjustments I would make to optimize Jimmy's portfolio as an MBA case study assignment, this is what I would do. In terms of the holdings, let me just pretend I'm Jimmy, okay? I'm 24, I'm an HVAC technician. If I was new again to the stock market, I would concentrate heavy into the big name ETFs like VU, SCHD, VGT, or VTI, and then use my leftover fund money for the high conviction stock picks, maybe just 1 or 2. Invest into what you know. I think that's what Peter Lynch said. Maybe like Vertiv and one more company. If not just Vertiv is okay because you have your bases covered with the ETFs. Now remember, I'm not Amos. Right now, I'm Jimmy. I'm new to the stock market. That's what I would do. So I would go heavy into the blue chip ETFs. And in Jimmy's case, it would be the Fidelity mutual funds for the S&P 500 and the total market. So if I were to break it down, this is for my portfolio as a young man entering into the stock market. I'm in my mid-30s, by the way. In case you're like, why are you saying young? Dude, I'm like 10, 11 years older than Jimmy. So about 70 to 80% into ETFs and maybe possibly 20 to 30% allocated towards individual stocks. And when I talk about individual stocks, I'm not talking about spreading it across 20 or 40 holdings. I'm talking about a concentrated allocation towards 1 or 2 that I truly believe in after studying and doing my research and homework and believing in them as a fundamentally sound operation that's going to compound my wealth. Not a gamble, not a speculation, not a narrative, or like, oh, this company's buying back their shares, but there's no growth in them. Shout out to Western Union. I'm not going to buy into them. Instead, I want to buy into something that's pioneering, is best in class, has a wide economic moat, and is just crushing the competition. Invest into that, not into something with an eroding business model with their economic moat getting smaller and smaller by the day. Not that. And if Jimmy quits his job in the HVAC field, invest into what you know goes out the window, right? Depending on where he pivots next, do not go into a warehouse. Please. do yourself the favor and don't go into a warehouse and break your back, then it's hard to go wrong with the Mag 7. To be honest with you, Microsoft, Google, Apple, Amazon, any one of them except possibly Tesla, because Tesla, they defy the odds, and oftentimes their fundamentals and financials do not even matter. Okay, so Tesla is the only one where I would hesitate, but the rest of the Mag 7 sound. So hard to go wrong with the Mag 7, but it's easy to go wrong with speculative stocks. And I would argue it increases the probability of failure when I invest into a business with declining metrics and ugly financials. So with speculative stocks, I would stay away from at all costs. It doesn't matter what you saw on Twitter or Reddit, YouTube, TikTok. If a company's success in the stock market is not predicated upon their financials and the growth of their profitability, their EPS, revenue, free cash flow, and dividend growth rate, but instead they're drowning in debt, they're unprofitable, they're losing market share all the time, and it's speculative, and there's hedge funds and big money shorting that company, but it's based on a narrative of like, dude, this company's gonna 10x because of this. Don't buy into the hype. Sometimes the hype does pay off, but I would argue that's gambling. That's going into a casino and just pulling on the lever of a slot machine. You don't know if it's gonna pay out or not. Case in point, a very recent example would be Intel. Now, Intel's revenue and all of their metrics and fundamentals have been declining for the past 2 to 3 years, going deep into the red and eroding. Correct? However, for the past week or so, they've been soaring and they're finally experiencing green because there's all this speculation that's playing out in their favor of like Apple investing into them, potentially the government taking them over. But as it stands right now, their numbers and data look pretty bad, but the narrative, it is in their favor. But what I'm trying to say is, if you invest based on speculation and in the story rather than the fundamentals and financials, the success rate is going to be a rough situation. For every one company that succeeds based on the narrative and their story, you're going to see 99 fail. Whereas if you go with the financials and fundamentals, you increase the probability of picking a winner. Now, because I'm Jimmy, me personally, saying that I have 14 individual stocks, I wouldn't go and sell everything to create taxable events, but instead I would probably add further contributions into my portfolio towards the S&P 500 ETFs and the total market ETFs that I talked about earlier. And I would do that until I learned how to evaluate and analyze a stock after playing around with paper money. The third bullet point that you can see right there. You can hop on over to, there's so many different stock market simulators out there where you can pick and choose what stocks to invest into with a hypothetical sum of money, like $5,000 or even like $200 or even 10 grand, right? Do that until you learn the ropes and you get to a point where with your little hypothetical portfolio, you are more correct than you are wrong. If you get to that point where your success rate is at least 51%, then you are improving. That's what I would do if I was new, because I wouldn't want to go all out with real cash and real money, because at like 18, 19, 22, or 24, dude, that's hard-earned money. So I wouldn't go all out with your hard-earned money until you learn about the consequences, the rules of the game, and how stocks move up and down, like what propels them to succeed. So even though the professor grading my assignment might not agree with me, I would still say I'm gonna do paper money until I feel comfortable. And if I never reach that state of being comfortable and I keep losing in my paper money portfolio, then I'm gonna stick with the blue chip ETFs, because that's never the wrong move. And there's no shame in doing that. If you just jump into SCHD, VU, VTI, you'll still get a modest total return year over year, 10, 12, 14%. That's not bad at all. Now, you might be like, then Amos, why do you waste your time picking individual stocks? Because personally, I outperform the market almost every year except back in like 2022. Because in 2022, I went gung-ho into 3M, Meta, and they were going on a sell-off beyond belief. But subsequently in 2023, that allowed me to outperform the market because they rebounded like a machine. But anyways, I pick individual stocks because number one, I enjoy researching and analyzing companies. And then number two, because of the better ROI. And then number three, doing the stock stuff, dude, I'm passionate about it. It's my hobby. And then number four, it's because I'm a firm believer in that Why would I invest into the S&P 500 if I could just invest into the winners that are inside of the S&P 500? Why should I invest into the losers in the index as well? And then number 5, with enough repetition and practice, I finally know how to evaluate and analyze a company. It's such a rewarding feeling when you do your homework and you see that a stock is undervalued and Wall Street and other investors are wrong about it, so you invest into it and then you give it like 3 to 9 months to marinate, right? You shouldn't just take it right out of the oven. And then you look at it about 10 months later, it's like, bam, it's up in the green 50, 60, 70%. Dude, it's such a great feeling. So me personally, I'm always gonna stick with individual stocks. But for the most part, the ordinary individual, the average person, probably better off with ETFs, because I'm gonna tell you this right now, it requires a ton of time, effort, and dedication to be monitoring the stock market and analyzing individual stocks. You wanna save the time, ETFs, not the wrong move. And for the love of Domino's Pizza, please do not venture into day trading. Now, I'm talking to myself because I'm crazy, I'm delusional. I'm Jimmy, I'm a black dude, 24, I'm an HVAC technician. I'm telling myself, dude, stick with long-term value investing, because you could still make a great ROI and fantastic returns without having to resort to doing day trading. I feel like so many young people, they jump into the stock market with the false promises of 10xing your money with these speculative bets and gambles, and it makes me so frustrated to see other people advocate and support that type of style of investing. Because when it comes to day trading, you're not investing. Investing is putting your money into a business operation and then letting it grow, correct? Day trading, you're putting your money in and then you're taking your money out, sometimes in the same day, but oftentimes in like a 24, 48 hour time period. That's not investing. I know this is gonna be unpopular, but day trading is gambling. And that's why I smiled like a little freak when I read that his goal was for safe and steady growth. Because I think I would have been kind of pissed off if I saw I want to 10x my money, all or nothing. I would have been like, dude, first you need to take a chill pill. If you're trying to 10x your money overnight or by next week, dude, that's not gonna happen. But at 24, to understand the principle of slow and steady wins the race, you're actually way ahead of your peers, Jimmy. I'm saying that right now. I'm talking directly to you. We're making eye contact because I know you're watching this video while you're sitting on the toilet, dropping a disgusting brownie. I get it. But as I make eye contact with you in this awkward scenario, I'm proud of you. You're way ahead of your peers. Because I don't think your frontal lobe and the rest of your brain, it doesn't fully develop until you're like 28, 29. And in my case, dude, I feel like I wasn't thinking clearly until I was about 31. It took quite a while for me to get into that perspective. So at 24 to understand that, that's amazing. Now, everything that I just said in this video, on this slide, and on this entire YouTube channel, none of that and this was financial advice. I'm not a professional financial advisor. I'm not a CPA. I'm not your therapist, but I am your friend on YouTube. And this is how I would answer the MBA case study question of what would I do as a beginner in the stock market? This is my portfolio just for fun. Okay? Now, if you're still watching this video, help me out. What do you think of Jimmy's portfolio? What constructive criticism would you give? What did you learn the hard way? Like, to be honest, at age 24, what do you wish you knew? Maybe Jimmy will thank you. And in case you haven't seen it already, for a deeper play-by-play for a beginner and what I would do in the stock market, I actually made a video talking about that topic. It goes into depth about how prioritizing the Roth IRA should be the move. And again, I'm talking to myself because I'm crazy, but that video is definitely worth the watch. And before you head out, I just wanted to leave you with this. Whatever it is that you're going through right now, no matter what battle or storm it is, or how heavy it feels on your shoulders and on your chest, at the end of the day, you're going to be okay. Sometimes I think it's really a nice gesture to just be reminded that it's going to be okay. Because if you think about your past and your history, no matter what it is that you went through, you overcame it. You came out on the other side. You made it to the end of the tunnel time and time again. So what makes this situation any different, right? I mean, if it's money related, dude, you can always make more money. Money comes and money goes. So I'm going to say it to you. You have what it takes to make money again. And besides, dude, after we perish and we turn into dust, We can't bring anything with us, right? Money is just ours while we walk around on planet Earth. And if it's about relationships, if you're going through a tough time with your significant other or your buddy or coworker, it's never too late to take the difficult steps to becoming a better person. Owning up to your mistakes, apologizing, learning how to communicate better, learning how to forgive, and to be a better human overall. Because I'm going to say this right now. If you're doubling down on being wrong and you continue arguments, dude, you're being a jerk. You're genuinely being a jerk. I think being confrontational all the time, it's not good for your soul, nor for your mental health. Sometimes you got to choose peace over being right. I'm saying that for the people in the back that aren't paying attention. I'm at that point in my life where when people want to throw me into an argument or a conflict situation and they say the earth is red, I'm gonna be like, yeah, you're right, the earth is red. I'm not gonna sit there and try to argue with them because, dude, I prioritize my peace. I can't believe that because when I was younger, dude, I would get into it. I'd be like, are you stupid, red? Are we looking at the same thing, you bozo? To be honest with you, to see the growth that I made as a man and as a human being, light years. Dude, I was so immature and so stupid when I was young. Yeah, and number 3, if it's about your health, if that's what you're struggling with, please do not underestimate the power of being consistent in your diet, in the gym, and making the right choices. When I was struggling badly with my mental health, I think I talk about it openly on this channel a lot, right? I stopped doing any self-care. Dude, I used to just eat junk food. I would just ruin my sleep schedule on purpose. I stopped working out altogether because I was like, what's the point of being strong and healthy? I don't care. And to be honest with you, all of those variables and factors that added up to just worsening my condition. So even though right now I'm a pencil neck, these days I work out every single day and I'm feeling a lot better. I can finally say that there's more days where I feel calm and normal than I do feeling absolutely miserable. So that's good. And because I made all of these changes, I can say for me, there's definitely a correlation with positive self-care and having better mental health. So I truly understand why people say your health is your wealth. So I just want to encourage you to take care of yourself. Now, enough preaching. I love you guys. Stay safe. Good luck in the stock market, and I will talk to you next time.